MPC's decision about interest rates in the UK. So the running order will be the same as usual, which is that I'll briefly summarise their monetary policy decision, and then we'll run through some of the logic behind that. But also at the end, you can ask questions about anything you like. I see we've already have a super chat, so thank you for that. And if you do have a super chat, obviously we push your question to the front of the queue. Now, obviously, from an investor point of view, what's really overshadowed this announcement is the announcement of a trade deal between the UK and the US. So I can talk about that too, although I've just seen the actual details of it literally just now, but I'm happy to discuss it. And that's absolutely fine, because that's how we do things here on the fly. So just to summarise what's going on, obviously the Bank of England cut. Many people thought it would, and it did. So just as with the Federal Reserve yesterday, which everyone expected wouldn't change policy, and it didn't, many people expected that the Bank of England would cut interest rates by 0.25 percentage points to 4.25%. So that's where bank rate is now. And this is the fourth cut that we've had so far in this rate cutting cycle. Now, it was widely expected, so I think the market impact is going to be fairly limited. But we can take a look at what happened to markets in a moment if you want to do that. Now, it was interesting because whereas the US vote from the Federal Open Markets Committee, the FOMC, whereas that was unanimous, the UK vote was actually split 5-4. So obviously recent trade developments have shifted some of the minds of the members of the 9 members of the Monetary Policy Committee. 5 of the members supported the rate cut. 2 of them actually wanted a half percentage point reduction, and 2 of them wanted rates to remain where they were. So clearly there's a difference in opinion here. A lot of that difference in opinion will be based on the stickiness of inflation. How sticky is inflation? Will people be anchored on higher inflation? And will that become a self-perpetuating prophecy and keep rates higher keep inflation higher for longer? Because if it is sticky, then it takes more effort, more restrictive policy for longer to bring interest rates down. But clearly the kind of direction of travel now is very much towards more members expecting that inflation is going to fall further. Growth, remember, is quite weak in the UK, and although that's not explicitly part of the Bank of England's mandate, they certainly would consider it. And given weak growth, it's likely that they will carry on down this road of cutting interest rates. And we are seeing a divergence now, of course, between the UK monetary policy, which is getting easier, and US monetary policy, which is remaining restrictive, as they're kind of frozen in the headlights of all of that uncertainty. Now, of course, we've got uncertainty here in the UK as well, but we haven't chosen to impose tariffs against every other country in the world. We probably couldn't anyway, but we haven't chosen to do that. So it's interesting that we'll talk about the impact of the uncertainty and the trade policies in a moment, but it's not what you might think. But overall, yeah, obviously inflation growth has been weak in the UK. It's quite disappointing. Inflation's been close to the 2% target since the middle of last year, which is good for the Bank of England. And obviously it's come down from a peak of 11%, so it's a big win. But what they do expect, the Bank of England, is that inflation will rise temporarily, they say, to 3.7%, and that's because of higher energy prices. And then they expect it to fall back to their 2% target. But of course, there's huge uncertainty around these forecasts. But let's take a look. Actually, I'll show you the forecast itself. There's a nice little picture here from the monetary policy statement today. Here we go. So this is their forecast for inflation. The diamonds, which you can see here, are their forecast. So it does pick up a little bit, but then it kind of tails off back down to back down to their 2% target over a longer horizon. So yeah, a little bit of a hump here that you can see, but then gradually it falls back down to that 2% target. Obviously, huge amount of trade policy uncertainty. You've probably seen these trade uncertainty indices before. They've just gone vertical, and of course it's due to Trump's trade policies. And you can actually see their long history of their bank rate here, going back to before 2000, and you can see that, yeah, we're coming off this very restrictive period. We're still quite restrictive compared to this period of zero interest rates since the global financial crisis, but we are starting to see normalization, which is fair enough given that inflation has fallen quite significantly in the UK and growth is quite weak in the UK. So overall, a weakening of UK growth, pretty weak growth, it's got to be said. In fact, let's just pull up the growth assumptions for the UK. So that's CPI. Yeah. Let's find the growth assumptions. Here we go. So this is their forecast summary. This is kind of a baseline summary. In other words, it's a central case when in fact it's of course quite uncertain. Now the previous forecast was in parentheses here, and you can see that they've actually revised Q2 growth for 2025 up slightly. Q2 of 2026 has been revised down a bit, and Q2 of 27 is revised up a bit. So not a huge impact, negative impact from tariffs, which is kind of interesting. But certainly that's UK growth is not great, right? So growth of 0.8%, 1.3%, 1.5% is pretty weak, even for a developed market country. And in terms of their monetary policy, they do expect it to get easier over the years ahead. 4.3% for Q2 of 25, down to 3.5% for Q2 of 26, 3.6 and then 3.7. So certainly not going back to zero. Don't expect that. In fact, what it seems to be heading towards is around 3.6 or 3.7 over this roughly 3-year horizon from their forecasts, which might be a shock to some, but you know, I've always been rattling on about the fact we're not going back to zero. So yeah, I mean, we can go through these judgments later, but I think overall the story is one of, you know, pretty weak economic performance in the UK. We're a very open economy. There's huge uncertainty due to trade policy. Overall, due to the counteracting effect of the different channels on the UK economy, it's probably not going to have a huge negative impact, the trade policy in the US, because the three channels by which the trade war is affecting the UK. One would be direct tariffs. So we have this 10% overall tariff, which is still in place after the trade agreement today. Then we've also got trade policy uncertainty, which is obviously going to affect the entire world, and changes in financial markets. So what we've seen is the dollar's actually weakened, which was a bit of a surprise, versus sterling. And when you factor those three channels together, the Bank of England thinks they roughly offset each other. So there's a relatively small net impact on the UK in terms of our economy. But of course, this is all subject to a huge amount of uncertainty. And the Bank of England does various scenarios to see how we could have supply chain disruption due to the trade policies and other kind of second round effects. But yeah, it's not a clear-cut decision. That's pretty clear from the split in the vote today. And because I think it's partly about that uncertainty, but also what's going on in the UK labour market and pay awards. Is it the case that pay growth is going to really tail off in the UK? Certainly the NIC contributions, you know, the new tax on the higher amount that companies have to pay for national insurance contributions, that's probably going to push down wage growth because pay offers will be lower as a result of that, probably. But really, that's the judgment which the bank is trying to make here. Will wage growth start to weaken as a result of weaker growth in the UK and overall uncertainty around trade policy? So that's why they were split. But so far, the Bank of England says there's very little concrete data on how US-UK trade patterns have changed. It's just too early to see the changes. Because remember, it's only been 100 days, roughly just over 100 days that Trump's been president, and it takes a long time for this economic data to become visible. So we're still not seeing it in the hard data, but of course we will. Now, a lot of the stuff we export to the US is services. Now, you might think that they'd be unaffected by the focus on goods trade. But of course, recently, Donald Trump on Truth Social said that he was going to impose 100% tax on any movies made outside the UK, outside the US. And of course, a lot of UK gross value add is in this sector. You know, we're good at making films. We export it to the English-speaking world, the US, Canada, Australia, and so on. Unfortunately, the US is a very large market for us. So if they do impose that tax, it's not clear how it's going to be charged. If it's a US company filming in the UK, does that still count? It's not even clear that it's going to be legal. But if it does happen, it's going to be a bit of a blow. Also, wages in that sector tend to be pretty high in the UK. And we've only just recovered from COVID lockdowns on that industry. So that was a bit of a shock. So even the services industry could be affected by tariffs, even though strictly speaking it's all about goods. So that was a bit of a shock, and a very surprising shock for the UK. I don't know whether in the agreement today that was excluded, whether the UK film industry was excluded from the tariffs. I can have a quick look in a moment. But anyway, let's turn it over to you. We'll turn it over to you for questions, and then I'll just summon my dog just so you have a chance to think about questions. We do already have a super chat, so that one's already loaded up. A very generous one, thank you for that, and a very relevant one actually, because of what's happened to the monetary policy, UK monetary policy today. Just see if films were included in that. So we're going to get reciprocal market access on beef. So Teddy's very fond of biltong. These are beef snacks. There we are. Managed to get that into the into the live stream. There we go. There we go. Beef. Now, is it treated by hormones, Ted? No, it's not. Not yet. How about some nice chlorinated chicken? Yummy. Very good. Okay, back to Laura. She's got some unhormone treated biltong. So still 10% tariff on most goods imports to the US from the UK. Reciprocal market access on beef, with UK farmers receiving a tariff-free quota of 13,000 metric tonnes. And there'll be no change to food safety standards in the UK. So maybe it won't have hormones in it. UK will remove the tariff on US ethanol. Great. But apparently that threatens British farmers. Because in the UK we grow bioethanol, so that would be a direct, that would undercut our bioethanol market. There we go. But all of these trade deals will always come with trade-offs, so we're always going to have to pay the price in some way. And what else have we got? Have we got pharmaceuticals? That's interesting. Preferential access to pharma and semiconductor sectors. That's good news. But overall, UK is still significantly worse position than before Trump's tariffs, apparently. Steel and aluminium levies gone. That's good. But obviously we're still waiting for a lot of the detail. There we go. So always some good news, some bad news about that. And the opposition party leader, Kemi Badenoch, has said that the UK has been shafted by the deal. So clearly the Conservatives aren't impressed by it. Oxford Economics says that it's not going to change the outlook for the US economy. Of course not, because the UK is so small. But the effect on the UK, it nibbles away at the US effective tariff rate, but it's likely to remain in the double digits anyway. So not a huge change. So in terms of deals, really I think this is a kind of optical thing for Trump to say, oh look, I've actually made a trade deal. Because to achieve trade deals in a space of 90 days would be incredible. 90 deals in 90 days is very unlikely. But, you know, I think we're probably going to be one of the countries which will help him look good, even if the actual trade deal is not very substantive at all. Yeah, I can't see anything about the film industry. Oh, here we go. Still a threat on services in the film industry. Here we go. Trump says film tariffs are separate from UK deal. Talks with the UK on his plan to impose tariffs on film imports would happen separately from the trade pact announced on Thursday. James Bond has nothing to worry about, the US president said, before praising the late Scottish actor Sean Connery. Okay. Brilliant. So now on to your questions. And first one is super chat. Very generous super chat. Thank you, John Close. And John Close says, looking for a replacement for Vanguard money market fund. What are your thoughts on Vanguard's short-term bond index funds paying 7%, and which one of the 6 might be best? So let's have a look at those funds. First of all, let's have a look at the SONIA rate, which I now can access. It was a plugin on my computer. It wasn't the Bank of England, and I've been blaming them all this time. Bank of England. Yeah, if you ever want to look up the rate of return on a money market fund, just Google for Bank of England SONIA rate, and this is the page that pops up. Now, the Sterling Overnight Index average is roughly what you earn with a money market fund. It doesn't really matter which one. If there's an accumulation fund, all of them will roughly earn SONIA. And for the members, I often post this grid of 6 different UK accumulation money market funds, and the return on them is very similar. There's very little to distinguish between them. But let's have a look at the SONIA rate. I doubt it's updated for today, but we can see it up till yesterday eventually. But this is really easy to look up. It takes a while, but it's really easy to look up. And so if you're ever wondering what bank rate is how it's going to affect your money market fund, this is how. So you can see that up till yesterday, the SONIA rate was 4.45. So that's 5 basis points, 0.05% below bank rate, which was 4.5. So if bank rate gets cut by bank rate has been cut by 0.25 percentage points. So that's going to go down to 4.2. 4.2 probably for your money market fund. So that's still pretty good. That's still considerably higher than inflation. So you're getting a reasonable real return for something which has a very low volatility. But let's go back to Vanguard and have a look at what they offer. So I'm surprised they've got that many they've got that many bond funds. But let's go for building my own portfolio. bonds, and I'll go for passive ones. Well, let's include active as well, and we'll just restrict it to accumulation funds initially. So what have we got? We've got one that you said, which has if I don't know if you're still on chat, just still available, but could you tell me which one you're looking at, which has a 7% yield? I think you did say. Let me just quickly check. Here we go. Vanguard short-term bond index funds paying 7%. I'd be surprised by that. It'd have to be pretty low credit quality to pay out that much. Maybe it's not the bond one. Maybe it's the... You say it's short-term bond index fund. I can't see it there. Anyway, back and have a look at this. Vanguard short-term bond index fund. Here we go. Global short-term bond index fund, hedged accumulation. So let's have a look at that just to see what the yield is. Now I see 3% as the yield. So that's the accumulation one. Yeah, so 3.1% gross is what I see there. I assume this is not the one you're talking about, but 3% is kind of more what I'd expect at the moment. If it is going for investment grade credit, which is higher credit quality, if you go for a junk bond fund for the moment, you kind of get 7. So something like STHS from PIMCO, that would pay about 8%, I think, from memory. So if we look at that one, yeah, 7.9 is what you get with a junk bond fund. And again, this one is currency hedged into sterling, and this is actively managed, so the fee's pretty high on this one. The fee is fee is 0.6% for this one, whereas for the Vanguard one, certainly this one I think is passive, and the fee is 0.15. But you know, I'd be shocked if you'd have to go into junk bonds really to get a 7% yield. And Vanguard, as far as I'm aware, doesn't have any junk bond funds at all. That's one of the things they don't have. They've got a very restricted set of funds. So I don't think that's an actual fund. But you know, if you're looking for an alternative to a money market fund, let's have a quick look at the UK yield curve, because my point, I guess, is that it's not going to be easy to get a 7% yield. Not unless you're willing to take a lot of risk with your fixed income investments. So let's pull up the new trackers, and we'll just pull up the yield curve. So this is as of yesterday's close. These are UK bonds. So each of these blobs is one bond. There are about 63 of them currently which are available and outstanding. These are all 63, and we go from 0 years to maturity up to about, 48 years to maturity. So this one matures in 2073. I'm not going to see that one mature, let's face it. But the yield, what I've put on here is a SONIA rate. The dashed line here is a SONIA rate, so that you know what you get roughly with a money market fund. And that way you can compare it with what you'd get if you lock in a yield by buying a single gilt. And you can see that for the short end of the curve, you've got to go all the way out to, 10 years, until you start to exceed the money market rate. Now, when we cut it to 4.2, we'll maybe cut that to 7.7 years. So you've got to lock in a yield for 7 years in order to match what you'd get with a money market fund. But of course, with a money market fund, as the Bank of England keeps cutting, you'll have to absorb that lower interest rate. Whereas with one of these gilts, you lock in the yield the day you buy it, if you hold it to maturity. So if you do go for UK gilts, if we average out the yield and you buy a fund like VGov from Vanguard, So let's have a look at VGVA or VGov. So VGVA is the accumulation one. The yield on that will probably be much lower. Yeah, so something like 3.8%. So the income version, yeah, 3.8%, 3.7%, which is not surprising if you look at the bonds it's buying. It's kind of at the lower end of the curve. So, you know, alternatives, if you go for UK gilts, you're not going to earn much. You're going to get about 3.7. If you lock in the kind of longer dated UK gilts, you'll get above 5%. But of course, for most of us, holding a 20-year bond, it can be quite volatile, and you may not be willing to hold that to maturity. But, you know, those are the choices. So if you want safety and you want a higher income than you're getting with money market funds, it's still quite restricted in the UK. You're going to have to take more duration risk from 7 years out, and or more credit risk by buying junk bonds or maybe investment grade corporate bonds. So investment grade is not going to give you much juice. So if you go for one of Vanguard's global bond funds, let's zoom back out here. Let's go back to the are we still on bonds? Yeah, it would be nice if they had a filter based on maturity. Sort yourself out, Vanguard. This gilt fund is the one we were just looking at. This buys at all gilts, 68 holdings, all 68 of them, 68 not 63, sorry. Actually this one, 88 holdings, so maybe that's got some linkers in it as well. But if we go for investment grade UK bonds, let's just see what we'd get there. Oh, I don't want to buy it, do I? Live. Okay, let's see what the yield is on that one. Go for the income, and we go for distributions. What are we going to get? 3.95. So again, well short of that 4 that you were talking, of that 7% that you were talking about, and that's just investment grade credit. And I don't think they've got anything worse than investment grade. Let's look at the US investment grade. I don't think it's going to be much better. So this is sterling hedge, so you're not taking the currency risk. Yeah, so there you're getting 4.3. But again, you know, that's well below what you were talking about. So those are the choices. Do you go down the junk bond route, take more credit risk, in which case it's more crashy? And of course, if we do have a big weakening in the UK economy, the US economy, default rates will increase and the price of those junk bond funds could fall 10, 20% or even more. As long as you're willing to weather that, that's fine. But that would be a better buying opportunity when spreads widen and prices fall for those junk bond funds, which is kind of what you'd expect if the US goes into recession. Or you can lock in rates for longer. Those are the two choices. Neither of them particularly palatable because you have to take more risk, which may not be what you want. So I hope that answers your question, John. John says maybe they're reading it wrong. Or maybe that's what Laura says. Yeah, okay. Sasha Barlow. Hello, Sasha. She says, money market fund on Interactive Investor is currently paying 7%. Royal London money market fund paying 7.2. And then someone else has said that it's 5.3. So let's have a look. Let's have a look at the Royal London. And I'll show you how to calculate it. Let's do that live. Let's do it. Let's do the calculation live. How exciting. So let's get that Royal London money market fund. And let's use PensionCraft just to pull up the fund itself. So we have our cheapest funds list. And money market funds are one of the categories there. So we'll go for UK. We've now got the Europe category. So we'll go for UK, money market, and we'll go for Royal London. So that's this one. So I'll copy the ISIN code there. And let's have a look at their website. Sometimes they give you the performance and they give you the current yield. Can't see the yield there. I can't see anything there. Okay, that's not good. come back to that maybe. But let's calculate it. I think that's probably a better exercise because you'll learn something potentially, and it could be interesting. So we'll look up the ISIN code on here. So here it is, Royal London Short-Term Money Market Fund. So this is an accumulation fund. That's a really important thing because you'll notice that its price isn't rampy. It used to be an income fund, but now it's an accumulation fund. So the gradient there tells you the rate of return, and that'll be roughly equal to SONIA. If you plot one versus the other, they're very close. So what I tend to do is I take the prices spaced some period of time apart. So currently it's the 7th of May. So the price today is 116. So I'll make a note of that. 116.058. So that was the closing price yesterday. And we'll also go back a month, let's say. So 7th of May, so we'll go to the 7th of April when the price was 115.626. Okay, and then what we're going to do is we're going to annualize that. So here we are in R, and forget the gubbins at the top. So those are the two prices we looked at, 116.058, 115.626. Now if we have 12 months per year, we raise that to the 12th power, we subtract 1 to turn it into a percentage, and you can see that over the last month or so, the rate of return is about 4.6%. Let's multiply by 100 just to make it easier. Yeah, 4.6% is the current rate of return on that money market fund. So pretty much in line with SONIA as it was over this 1 month period. Of course, now if we were to do this in a month's time, very quickly that Royal London fund will pick up the lower interest rate, and we'll see it fall by 0.25 percentage points or 25 basis points. So that's going to fall to that minus 0.25. So I'd expect this to fall to about 4.3 once the Bank of England's monetary policy decision gets picked up by the investments. Now, of course, because the duration of the investments, which Royal London's money market fund owns, and let's have a look at them quickly, because the maturity range is very short, so you can see that hardly anything has a maturity more than 1 year. In fact, the vast majority of it has a maturity which is, less than a year. So that means that it'll very quickly pick up that lower interest rate at the short end in the UK because of the short maturity of the bonds, and they're always churning quite rapidly. So certificates of deposit, commercial paper, that's the other thing it would buy. These are IOUs issued by companies, and of course UK government bonds which are about to mature, which have a very short maturity. All of those would be part of the things which these funds can buy. So you can see some of the holdings there. Pretty low pretty low for UK money market fund. So any UK money market fund will give you roughly that 4.5, soon to be 4.25 SONIA rate. So SONIA is really important to be aware of, and also to understand that that's what money market funds generate. Here we go. John is back and says, John says, Roman, look at risk level 3 out of 7 on Vanguard, 6 funds, Japan no good, other 5 about 7%, VGST, BGA. Let's have a look. So there we go, and I'll change the risk level 3 out of 7. Okay, and I'll share my screen. Here we are. Which one was it? Global short term we looked at. Global short term corporate, maybe that's the one. And if we look at the distributions, 3.94. I can't see one. Let me try looking up the name you've given me. VGSTBGA. Maybe that'll work. Here we go. Hedged income. And the distributions. Yeah, again, it's 3.05% is the current yield on that one. So I think what you're thinking of is probably not the income, it's the overall price and performance. So that also takes capital gain into account. So that one has been rising as presumably as short-term interest rates have been falling. There's been some capital gain as well. That's the only thing I can think of. If we look at the currency exposure, I just wonder where it's got the most currency exposure. Does it have a country? Credit maturity. It's going to be US dominated, 40% if it's market cap weighted. Yeah. Vanguard isn't great when it comes to slicing and dicing its funds. iShares is much better. But still, 4%, 4.25 is going to be what you're going to earn with or 4.2 for UK money market funds going forward with the new level of bank rate. To earn 7%, you've really got to go for junk bonds or much longer maturity. Well, even if you went for really long maturity UK gilts, you're going to get 5% yield. There we are. So, next question is from ConCon MCMC. Welcome back. Very generous super chat, thank you. He says, or they say, not sure. I loved your return stacking video. Could you go into more detail about what other ETFs you might include with NTSG? And should a younger investor consider this instead of 100% MSCI World? Yeah, so if you're not familiar with the concept of return stacking, I made a video about this recently. The idea is, let's say you've got £100 to invest. You could put that into a 60-40 fund, but then all of your capital's used up. But what if you could get a slightly levered version of 60-40? So now instead of having to invest £100, you only have to invest £66, but it gives you exactly the same risk and return as if you'd combined 1/3 cash with 2/3 of the levered fund. So let me just repeat that. The actual exposure you get if you combine 1/3 cash and 2/3 of this 1.5 times levered 60-40 fund is exactly the same or very, very similar to having the 60-40 fund on its own, minus the expense ratio, any difference in expense ratio of the levered fund, and the funding cost of the leverage. Now at the moment the funding cost is probably quite a bit higher than it was, but for 1.5 times leverage there are various ways you can get that exposure. You can get it via the futures market, you can get it via derivatives potentially, although that's much more complex. Probably the futures market is the way they do it, a lot of these fund managers, and the way Wisdom Tree does it as well, I think, although I'm not sure about that. Certainly for the bond component they go for bond futures, but they've got a little bit of leeway as to how they can get the exposure, but there is a funding cost which is implicitly baked in. Now those funding costs will be falling as the Bank of England cuts, as the Fed cuts eventually. We will see those funding costs fall, but that's how it works. Because you've only had to invest 2/3 of your capital, £66 instead of 100, well now you've got £33 to play with. So what are you going to buy? Well, you can just buy something which is uncorrelated with bonds and stocks, but which itself generates a good return. Now what would that be? People often choose things like gold because gold is uncorrelated with equity and bonds. When equity and bonds fell in 2022, gold held up. So that was actually a good period for this strategy. If gold falls at the same time as equity and bonds, of course, that's a problem. So you could also have things like broad commodities. Usually the composition of that's dominated by oil. So if there is a big oil spike, which creates an inflation spike, which causes bonds to sell off because inflation is toxic for bonds, it causes equity to sell off, as we saw when we got the inflation spike in 2022. Well, the commodities would have been helpful then. So that again, the commodity exposure might be helpful there, excluding gold, which is also a commodity. So I think for someone who's young, yeah, a bit of leverage, not a lot, combined with return stacking could well make sense for a very long period of time if you stick with it. And that's really important. You've got to stick with it. And there will be periods when the leverage is going to hurt you, but the diversification in gold and commodities or whatever you choose actually will be a good thing. Another thing which they use in America for the return stacking is, and apparently there is one UK fund of this type, but it's called a, let me see if I can find it, Winton CTA, here we go. So these are called trend funds. In America they're called CTAs. Let's see if so this is the one that we've got in the UK. There aren't many. I think this is the only one. Michael told me about this, I wasn't aware of it, but you can buy this. But the idea here is that they can go long or short the market very easily via the futures market, because remember, with a futures contract, going long and going short is just a matter of switching contract. So that's how the fund manager will work. If they think that equity is going to go up, they go long. If they think equity is going to trend down, they go short, and they can make money in either situation, assuming they make their call right and assuming that the trend persists while they have the exposure. And they can do it with currencies, they can do it with any, really, it's got a very broad basket of futures that you can, there's a very broad basket of asset types that you can get exposure to via futures. You can do it with the bond market, FX market, you can do it for equity. You can do equity indices, so it's pretty flexible. So this is uncorrelated in theory with equity because they can go long or short. It's uncorrelated with bonds because again they can go long or short bonds. So that's why some people use this as an alternative to return stack as well as their 60-40 core. So to answer your question, yeah, I think for young people it could be something to consider. Now that's not a recommendation, of course. You should always do your own research. If you don't understand what the levered core fund is doing, don't buy it. That's the most important thing. You should never buy something you don't understand or you're not comfortable with. Now on its own it's risky because it's got the 1.5 times leverage, but when you combine it with the other assets, when you combine it with the other assets in the ratio 2/3 to 1/3, then it becomes less risky because those assets you've chosen will be uncorrelated and provide diversification. It's not about risk stacking, it's about return stacking. Uncorrelated streams of return, levered core, and return stacked on top of that with the extra cash. That's the basic idea. So I think it's quite an interesting concept, and that's why I made the video about it. I just thought it was interesting. I've been wanting to make a video about it for a long time, but then Wisdom Tree finally made a levered core ETF available in the UK, so I could finally make the video. So I was quite excited about that. Back to your questions, which I've lost. Laura says, stop sharing your screen, in capital letters. I think that was a while ago. Okay. But I hope that's answered your question, Concon. So we'll take a couple more questions and then we'll call it a day. And let's see what we've got in terms of questions. Vanguard. lost the screen altogether? Yes, I have. There we go. So yeah, here we go. So ENG says the VGST BGA price moved 7.2% in the last 12 months. Yeah, so that's capital gain and loss. It's not about income. Here we go. Redmond D43 says, does this deal have any impact on UK currency? Yeah, I mean, at the margin, you'd expect it to kind of strengthen sterling, probably, because the effect on the US economy will be negligible, I'd say, except for the fact that Trump has actually shown that he was able to make a deal. But will it affect the US economy meaningfully? No, because we're just not a very important trading partner for the US. Whereas Europe makes up a third of their imports. The UK makes up, I think, below 5%. So we're not particularly important. So even if they have a trade deal with us, it's not really going to move their needle economically. But let's see if we can find what happened to sterling today. GBP/USD. Here we go. And share screen. And we'll change it so it does have intraday data. So the rather buff-looking Andrew Bailey started speaking, I think, today, probably at this time. So initially sterling strengthened, and then back down to where pretty much it started the day. So overall, not a huge difference. Remember that for the UK as well, it doesn't seem as if this is a kind of groundbreaking deal, in the sense that the base tariff rate for UK exports to the US will still be 10%. It seems as if there are quite niche parts of the market that these tariffs are going to affect. So, maybe that's why the effect is fairly negligible. But, if I had to characterize it, I'd say it's good news, kind of. But probably more important for the UK than the US. One more question and then we'll draw a line under it. What have we got? Yeah. Matey, you're competing with a new Pope for views. Oh, I can't compete with the Pope. So let's see what the news is about the Pope. Where we go? Oh, here we go. Robert Prevost, to be known as Pope Leo, speaks from the Vatican balcony. So there we go. So we can end on that happy note. We've got a new Pope. Peace be with all of you. There we go. So good news, I assume, if you're a Catholic. But one more question that's financy and then we'll finish. Festral, a regular, thank you for joining us, says, I'm dubious about oil. I read OPEC were looking to increase supply, but whether that happens is another matter. Yeah, it's certainly the case that the price has been falling, and it's certainly the case that they want to make it uneconomic for US shale to pump oil out of the ground. And what's kind of ironic is because the price of oil has been falling, what a lot of the rigs have been doing in the US is simply shutting off production. So ironically, even though Trump has said drill baby drill, the fact that oil prices have fallen has actually meant, as a result of tariffs of course, oil prices fell because economic activity was falling or forecast to fall. That meant that US rigs were actually being shut down, which is interesting. Kind of unforeseen consequence probably. Let's see if we can find the price of oil, cross asset benchmarks. Here we go. So let's look at West Texas Intermediate, and yeah, so that's fallen pretty dramatically. Let's zoom out a bit, that's always good. So the peak that we had recently was around $125 per barrel. That was in 2022, following the huge crash we had during the pandemic. Now we're going back to something like $60 a barrel. and it seems to be kind of range bound between 57 and 60. So if there is a huge increase or huge decrease in or huge increase in production from OPEC, that probably would push it down at the margin, although of course the US is the largest producer now, interestingly, globally. So the OPEC isn't as important as it was, but it's still very important. But it's very likely that the Bank of England has also factored in. Let's have a look at what they're forecasting for the oil price. So they're forecasting 64. Previously they forecast 74, and they think it's going to. This is probably read off the futures curve, I'm guessing. So $64 a barrel, 65 in 2027. So not a big drop from here is what they're forecasting, but I think that comes off the futures curve from memory. Yeah, here we go. Projection based on monthly Brent futures prices. So remember, futures prices don't predict. They just based on market expectations, which could be incorrect. But yeah, of course, it's very important for the UK because it's a big input to the UK economy. If oil prices fall, it's good for us. So at the moment, that's definitely one of the positives for the UK economy. It's good to see. Anyway, let's draw a line under it there. So further rate cuts likely in the UK. US is pretty much locked in wait and see. So if you are a UK saver, not good news, and more than half of us are savers, remember. But if you're a borrower, if it's about your mortgage, potentially good news, although of course mortgages are priced off the swap curve, not off the bank rate, but probably good news for you. Anyway, thank you for joining us. Thank you for your questions. Thank you for the super chats. Don't forget, check out our website, pensioncraft.com/membership, to join our community and learn more. And of course, we've got our new trackers, which are available to you if you are one of our members, the cheapest funds list, about 270 explainer videos, which I've made over the last 7 years for the members. And we have a chat application so you can ask questions whenever you like. So all of those are the goodies you get as a member. And we also have a free weekly market roundup, pensioncraft.com/newsletter to sign up for that. Anyway, thank you all for joining us, and good luck with your portfolios.